Good evening for you guys that are early. How's it, John? How's it, Bowman? Good evening, good evening. Kanyisa, good evening. Charlene, how are you doing? Nice to see you again. And Charlene, we're chatting tomorrow, eh? Yes, indeed. Leroy, good evening. Hello, Leon. Nice to see you. Mxole, Andre Orense. How's it, folks? You know how it goes on a Wednesday night. We do a bit of a Q&A. Tonight, I can't seem to get this camera completely centered, but I suppose that's not the end of the world. At least, or hopefully I look reasonably presentable. So yes, let's start. Any questions? Let's go with it. Good evening, Chippy and Chloe France and Marie and Micah and Andre Orense, Cindy Slos, Claude Silav. Okay. John the Quaker, good evening. Badrika, how's it? No, good evening. Joanne's world. Joanne, do you have an interesting world? H2 a Mampurboer. Well done, son. Let's have a good chat. Jock and Kristen, Heinrich and Shavir. Good evening to all of you. Please pop in whatever questions you have. Let's see if I can help you with a bit of financial advice, guidance, pointers, whatever the case might be. Top sent, you're awesome, ×1, the first gift they ever sent. I don't know what you do, but thank you, I suppose, whatever it means. Eva Poole, good evening. Fernand, hello Wesley, hello Rita. How's it, folks? This might be very interesting if I just have to greet people all evening and I don't get any questions. There's Lepo. Thank you very much, Lepo, for starting us off tonight. If you had 100K and looking for growth, where would you put it? Long-term growth, 5 to 7 years. So Lepo, you know what? This is the one thing that everybody always asks, what is the best investment? Where am I going to put my money? And it's so difficult to tell anybody because circumstances differ from person to person. So you might be the type of person that wants to get the best possible growth, but you're not willing to take risk. So you will have to go into a portfolio or an investment where there's not too much growth, but where you know that you're going to get a reasonably 9% return on investment. Or you might be the type of investor that says, listen here, you know what, I just want the biggest growth. I'm willing to take the risk. I know I could potentially lose my money, but that's okay. I want to get the best return on investment that you can give me. So let's go for it. Then you can look at alternative investments or arbitrage. And then you're looking at something like 25, 35% return on investment. So it all depends on you as an individual and the amount of risk that you can stomach. So it's really difficult to give you a straightforward answer, because if I could give everybody a straightforward answer in where to invest the 100,000 Rand to get the best potential growth, if there was a straightforward answer for that, I will be a multimillionaire. I would not be sitting in South Africa. I would have my own island somewhere in the Caribbean because I would be able to afford it, because people will flock to me to get the investments done. But we have to go and determine what your need is, and in line with your need, only can we advise you and give you an investment opportunity, so to speak. So I hope that answers it for you, Lebo. I know it's not the straightforward answer that you want, but it's the best I can do. Good evening, good evening, good evening. Charlene, if a portfolio underperforms, who is responsible to rebalance it? A financial advisor or client? Charlene, I would say it's the financial advisor's responsibility to rebalance it. If you are an educated client, there's absolutely nothing wrong with you as the client probing the financial advisor or approaching the financial institution yourself in order to do the necessary changes. But I also do believe that one has to make sure that before you just rebalance, that you go and you seriously investigate as to why the portfolio is underperforming. And just to give you an idea, when we went through COVID in 2020, 2021, all portfolios underperformed for a period of about 3 to 6 months. And a lot of clients at that stage contacted me and said, listen, yeah, I'm scared. My portfolio has dropped by 30%, 40%, whatever the case might be. I think it's time to withdraw the money, put it in bank and be on the safe side. And at that stage, my advice to everybody was just hold, just hang on, just hold, wait. And it was the best thing we could do, because 6 months later, once we went through this whole dip, the clients that held on to their investments, who saw a 35-40% drop in their investment value, after 6, 7, 8 months, the recovery that they had put them in a position where they had even more than before COVID. So they actually had recovered all their funds, plus had a 5 or 10% increase in the investment value. So I think it's always important for a client and advisor to have an open, honest discussion in terms of these portfolios and rebalancing it, and to jointly make a decision. But ultimately, I do believe it is the financial advisor's responsibility to speak to their clients and to make the necessary recommendations. Okay, Charlene, there we go. Good evening, Philip. How are you doing, Philip? You know, I told you I'm coming down to Cape Town in July. So, just by the way, if you do want to meet up when I'm down there, let me know. I believe you have sent me some messages and I've sent you some messages back. Let me know if you do want to meet up, and then maybe I can extend my trip by a day or two to make sure that I see you, okay? Hello. Who's next? All these gifter badges. Please, people, stop giving me gifts and gifter badges. Send me money, man. Send me money. When you have enough pension, is there a formula? Legend, yes, there is kind of a formula. And when I say kind of a formula, so you take whatever your gross income is, okay? If you take your gross income, let's make round figures. Let's make it quite simple. Your gross income is 10,000 Rand a month. After tax, it's 8,000 Rand a month. So you take that gross income, 10,000 times 12, 120,000 per annum, multiply that by 25, and that amount that you get to, that gives you a capital amount that should ensure a reasonably good and comfortable retirement. If you are looking at the net income, so the 8,000 times 12 times 25, it gives you a smaller amount, and then you're going to have an income that is sustainable, but most probably not as comfortable. So the question with regards to when is enough, that's the formula to get an idea. But I cannot tell anybody when enough is really enough, because for one person, all they want is they want money to pay their rates and taxes, water, electricity. They want to be able to buy groceries, sit on in their lounge day in and day out and watch sport. And they really have no real major financial strains. They're going to live a very simple life. And then you've got the person that says, no. I want to do 4 overseas trips every year. I want to buy myself a new car every 5 years in retirement. I want to splash out and buy big gifts and be generous and so on. And it's two people that both are going into retirement, but they've got completely different views of how their retirement should be. So that's where the thing comes in, that in order to determine what enough pension is, that's where I, as financial advisor, have to do a planning session with the client and say, okay, well, if you just want the basics, this is what you need. If you want this lavish lifestyle, this is what you need. And that is truly the only way to determine when enough is by doing a planning session in line with what you actually want. I hope that answers it for you, Legend. Philip says, battery about today, left my charger at work. Oh, Philip, okay. As long as you remember what I said, and send me a WhatsApp tomorrow. Okay, thanks, Philip. Mark Frederick, invest in high-end property or unit trust, 58 years old. So Mark Frederick, my mate, I'm not a very big fan of property. I have mentioned it from before. I don't think property is a bad investment. I think there's lots of people that make lots of money when it comes to property, but personally, I'm not a big property fan. And it's because I've had an investment property which I battled with for many years to get the rental income, to get it sold, all kinds of things. It's just a headache. It was a headache for me. I've had a number of clients that went through this property thing where you buy a property, then you refinance it, you buy a second property, and so you carry on until you've got 5 or 6 properties, and all of them went bankrupt. Okay, so I am not a very big fan of property, but I'm not saying it's a bad investment. I'm just saying it's not for me. I also know one of the leading estate agents in South Africa, who is a South African, actually living in Illinois in the United States. We had a long conversation the other day. He said to me, Corey, I've sold all my properties in South Africa. It's just too high risk. It's just the value is not there anymore. And it's different in the US. So if you ask me a straightforward question like that, I will most probably say go to the unit trust. Take the unit trust. I believe it's the better option. And the reason why it's the better option, you can go and pick a risk profile. So you can go and look at the different unit trusts. And you can go and look at a unit trust that gives you inflation plus 2%, but you can also look at a unit trust that gives you inflation plus 7%. You can invest in that. A portfolio manager has to look after it. You don't have to worry about whether the money is growing, whatever the case might be. All you have to worry about is that you put your money away. So to me, that is the better option, purely because it's less stress. It's less stress. Okay, Mark, I hope that answers it for you, mate. Let's see who is next year. Oops. Oh, sorry, folks. Oh, there's the person whose battery died. Sorry, mate. Let's see here. Okay, hi, Corey. Irshan Bachas. Hi, Corey. Not sure if this question was covered, but are there penalties for early retirement? Irshan, there is no such thing as early retirement. People keep on asking that question. There is no such thing as early retirement. Because legislation says when you get to the age of 55, you can retire. The only time that early retirement is seen as early retirement is if you've got a retirement annuity, for example, and it says that you retire at the age of 60, but now you actually retire early at 55, you can already take that retirement annuity and you can exercise your option. Same with your pension and provident fund at work. If the company says that your retirement age is 60 or 63, but you decide to go at 55, you can. And yes, there might be a penalty depending on how the product is structured. But that penalty is not a severe penalty. The bigger penalty is the penalty that you actually impose on yourself. Because if you did retire at the age of 55, number one, your capital now has to last for your lifetime. So let's say you're going to grow to the age of 80. That means that your capital needs to last for 25 years. That same capital at the age of 55 has now lost out on 5 years more contributions. It's lost out on 5 years more growth, because if you went at the age of 60, you would have been paying into that pension, retirement annuity or provident fund. You would have had growth. And now if you retired at the age of 60, now your capital only needs to last for 20 years and not 25 years, because you're still going to pass away at the age of 80. So that is where the penalty really comes in. It's the penalty that you impose on yourself by actually leaving earlier than what you're supposed to. In terms of the monetary penalty that the insurer charges you, it's insignificant in this exercise. Charlene, does Regulation 28 make your RA investment too restrictive in terms of growth? Not really, Charlene. And the reason why I say not really is Regulation 28 says that you can invest in a portfolio that gives you a maximum 75% equities, and of that a maximum 40% global equities. So 25% of your investment has to go into cash, bonds, property. So that makes it It's not a high risk, it's not a aggressive investment, but it's also not a medium risk investment. It's like in between. It's a medium high or medium aggressive investment. So yes, if you wanted to go aggressive, then Regulation 28 limits you a little bit. But if you structure a portfolio correctly so that you comply with Regulation 28, but you do have the maximum equities and global equities in your portfolio structure, then what's going to happen is those equities and global equities is going to grow much faster than your cash, your bonds, your property. So within a very short period of time, although your portfolio is 75% equities, 25% other stuff, because of the growth and the fact that the equities will outpace the other portion of your portfolio, very soon you're going to find that your portfolio is leaning towards 80% equities or 85% equities, purely because those equities has grown faster. So from that point of view, it could limit the growth a little bit. But now the thing is, and this is the magic thing about the RA, is the rebates that we get. The rebate is where the real power is. Because if you make use of your rebates in the right way, then your growth is going to be super fantastic. And purely for one simple reason, let's say your investment into your RA for the year is 10,000 Rand, you're on a 30% tax rate, so SARS is going to give 3,000 Rand back to you. If you get that 3,000 Rand back and you put it onto your retirement annuity, so you reinvest it, you still only have put in 10,000 Rand for the year. But now your investment is already sitting on 13% because you put that 3,000 Rand back in. And then you get the growth. Let's say you had 10% growth in your 10,000, that's an extra 1,000. So now you've got 14,000 Rand after the year because you put your rebate back into investment and you had your 10% growth. So you've had a 40% growth. So irrespective of what Regulation 28 says, you have outperformed just about any investment out there in the market. Okay, so I hope that makes sense to you, Charlene. Othello, as an 18-year, is it possible to retire in my 40s? Othello, mate, some people can retire when they're 25. Some people can retire when they're 30. Anything is possible. If you start your own business and you grow it like Elon Musk into this humongous company that you can sell for millions and billions, you can literally retire when you want. You know what the interesting thing is, Attila, is people that are really successful, really wealthy, really manage to build up enough capital for retirement. Those are normally people that don't retire. They've got the money, they've got the means, but they don't retire because they get meaning in life from actually doing their job, working in their company, contributing back to society. So yes, you could, very possible that you can retire in your 40s. But I think, you go talk to anybody, even if somebody retires at the age of 55. It's very exciting for about 6 months or 12 months, and then suddenly you're bored. There's nothing to do. So I'm a big advocate of people working as long as they can to keep their minds, their bodies active. And you know what? Then you've got time on your hands. You've bought yourself time to do absolutely what you want when you want. Okay, let's see who's next. Yeah, Legend. That's where you come in. I hope so, Legend. I hope that is where I come in terms of that. Okay, I'm looking forward to see you, Legend. Anytime, mate, anytime. Tembinkosi Diani. Evening, sir. I'm new in your program. I need to know what subjects. So I'm not 100% from East London, South Africa. Okay. I'm not really sure what you mean by what subjects. We discuss financial advice, and that means investment planning, retirement planning, estate planning. I'm a financial advisor, so I try and give people some guidance and advice and explain how our products work and how planning works and everything. So that's what I try and do. I try and enrich people's education in terms of financial advice so that they don't have to feel so intimidated when they need to approach somebody that is a financial advisor. Yeah, property is also not for me. Ams, then me and you are on the same boat. Agree to the same thing. Michael, what is the best product out there if I want to put money away for my daughter's education? So Michael, I'm going to give you basically the same answer that I gave earlier to the person that asked about the 100,000 Rand investment. It's virtually impossible for me to say what is the best product because it depends from person to person. It depends on your personal situation in terms of assets and liabilities. It depends on your income and therefore what your tax structure is. It depends on what you currently have in investments, what you don't have investments. So there's a whole lot of factors that needs to be taken into consideration. So let's look at this, for example. Let's say I say to you a tax-free investment is the best. And you can invest 3,000 Rand a month into a tax-free investment. But when we've done a calculation, you said you wanted to make sure that your child, your daughter will have enough money for a 7-year degree because she's going to become the super fantastic physician. So you want to make sure. Now we can't just say 3,000 Rand per month because we're going to have to save 5 or 6 or 7,000 Rand a month. So now I can't just do the tax-free investment for her. I have to do a combination of investments for her. But now, again, you sit and you want to invest this money and you've got the money to invest. But at the same time, you're sitting with loans of 500,000, 700,000 Rand on which you're paying 21, 22% per month, per year interest. It makes absolutely no sense then to go and invest 5,000 Rand a month where you're going to get a growth rate of, let's call it 12%, a good growth rate. But on the other side, you're paying 21 or 22% interest on a loan. Then your best investment is actually to go and get rid of that loan. So to determine what is the best product is going to depend on your personal circumstances. And that can only be determined by having a conversation, understanding your personal situation, and then based on that being able to give you an advice. Yo, folks, I am surprised with the amount of people here tonight. Last week, it was a bit on a quiet side, and I thought it was because of winter, and tonight it's cooking. So let's see. I'm going to have to hurry up, it looks like. There, that was Michael's question. Okay, let's see who's next year. Puskanavi. Interesting name. Okay, with pension fund lump sum, for example, 500,000, where's the best place? I hope you listened to the previous answer I gave because it's exactly the same. There is no best place. If there was one best place, then I won't have a job because then everybody would be doing exactly the same thing. But there is no one best place. It depends on you. It depends on your needs. It depends on what you want to accomplish. It depends on your goals. The only way for anybody to tell you where is the best place to invest your 500,000 would be to have a consultation with you, understand what your needs is, understand where you are financially, understand what your goal is going into the future, and only then can one say, okay, mate, take your 500,000 Rand and put it into a bank savings account, or put it into a unit trust, or put it into an endowment, or put it into arbitrage, or put it into an alternative investment. Only once one understands what your situation, your needs, and your goals is, then only can I advise you. Otherwise, I can't tell you. And like I say, if there was a one-size-fits-all answer, either I won't have a job, or I would be a multimillionaire because everybody would be doing what I'm telling them. Quentin says, thoughts on crypto, especially Bitcoin for long-term investment. So Quentin, I am not really a specialist when it comes to cryptocurrencies, okay? What I can tell you is crypto is here and crypto is here to stay. I believe that crypto has changed from this commodity that everybody saw as this potential great way to make lots of money to becoming more like a good share. So similar to a company that's listed on a stock exchange, that you go and buy and sell based on the quality and the value of that share. That's what crypto has become. So I think crypto, if bought and held for a long time, I think it will give good results. Yes, I'm sure in the short term, there's still potential for it to give the spikes that will give the good returns. But I honestly can't give you a good answer because I am just not a crypto specialist. That's why I deal in portfolios. I prefer to work with portfolios which I can advise a client on what they can expect, but I know that there's a portfolio manager and a whole team of people that is actually responsible for growing your money. When it comes to crypto, personally, I won't go and put my money into a specific cryptocurrency, but I will make use of arbitrage and put some money into arbitrage, purely because of how arbitrage works, which is linked to crypto, but it's not crypto in the real sense of the word. Quentin, I don't know if I answered your question, but I can't give you a straightforward answer, mate. It's just impossible unless you are a specialist in that field. And I think some people think they are specialists and they're not. In any case, Zorro says, how do I invest? Zorro, there's plenty of ways to invest. You've got basically, you can do it yourself. So you can go onto bank websites, you can open a share account, you can buy and sell shares on your own. You can go onto platforms like Easy Equities and you can go and buy a retirement annuity, a unit trust, everything on your own. Or you can approach a financial advisor, get advice and let them implement a specific product for you. So there's plenty of ways to actually invest. At the end of the day, the decision should be, what is the best way for me to invest? If you decide to do it yourself, then you take the responsibility of choosing a fund that has the risk profile that's in line with you, choosing an investment of which the tax benefits are in line with your tax benefits, deciding for yourself in terms of that product, whether it, or not deciding, but determining for yourself if that product is protected against creditors or not protected against creditors, understanding the estate duty and tax implications that goes with it. So all of that you then take responsibility for, and you have to, well, if it's good, it's good. If it's not good, it's not good. If you make use of a financial advisor, this is what the financial advisor has to look at. He has to look at a product that gives you the best tax benefits, the best estate duty benefits, the best potential growth in line with what your needs is, etc., etc. So it's up to you how you want to do it. Yeah, you must just decide and then approach somebody if you want to be assisted by somebody. Celia Browse, that's an interesting one. If you could, can you please revisit what to do with a lump sum and where to put Oh my goodness gracious, I don't know how this is possible, but this is the 4th time tonight that we have this question. Every time, just a little bit different format. I cannot tell you where to invest a lump sum. I can only tell you where to invest a lump sum once I've consulted with you. Only once I know what your circumstances are, I understand what your needs are, I understand what your goals are, I understand what your assets and liabilities is like. Only once I understand all of that can I advise you as to where you must invest your lump sum. If I don't know those things, I can't tell you. Because if I could, it would be a one-size-fits-all. Everybody gets the same product. And it can't work like this because we all have different needs. Okay. Business shakers. What's a high-end property? Well, I reckon a high-end property would be something like a property in Cape Town that looks out over the sea and is sold for millions in a good neighborhood where there's very small chance of the value of the neighborhood going down the drain. I believe that's what a high-end property means to me. Maybe you've got a different opinion, but that's what it means to me. Jock, naand oom, wat gebeur as ek groot boedel erf? Hoe word taxes op dit? Jock, my maat. Die eerste ding is, as jy groot boedel erf, kry advies. dis die belangrikste ding, want ek sê nou vir jou, ek het al baie boedels in my lewe hanteer, en ongelukkig het ek ook al gesê, dat baie mense, baie groot boedels, binne 'n baie kort tydjie, mors, en niks meer oor het nie. So kry goeie finansiële advies. Ek weet almal van ons dink, dat wanneer ons ewe skielik 'n groot klomp geld het, dan is ons die slimste mense in die wêreld, ons weet presies wat om te doen. Truth is, it's not like that. So Jock, just to carry on, I'm going to give it in English because most of the people that listen is English. So in terms of taxes, if you inherit, let's say it's from your mum and dad, for argument's sake, and so what will happen is their entire estate, okay, let's say the estate value is 10 million rand, and that includes everything, cars, houses, cash, investments, the whole thing, 10 million rand. So the first 3.5 million rand is free of any estate taxes and duties, and there's nothing to be paid on that. The difference of 6.5 million is taxable at 20%. Okay? So the executor of the estate, he will do all of this, and he will be responsible to pay that 20% to SARS. So he pays it out of the estate. So it gets deducted, whether he has to sell a car or a property or whatever to get the cash, that's what happens. He then pays that over to SARS. And then the difference is given to you. If it's a car, change of ownership. If it's a house, you can choose whether they transfer it onto your name or you sell it, you get the cash. So it's all up to that. But basically, the taxes are paid by the actual estate of the person who has passed away. So that is what is affected, the estate tax, and then of course executor's fees, because you're going to have to pay the executor. So that's what you can reasonably accept that will be paid out of the estate. But I always say to people that if you inherit anything from an estate, whatever it is, whether there's taxes involved, whether there's cost involved, it doesn't matter. You must just say thank you very much, because this is a gift that I've received that I did not deserve, I did not work for it, I do not have any rights to it. So irrespective of whether there is cost that comes off, I must just be thankful for it. But yeah, that's how it's going to work, Jock. Let's see. Whoops, see, there we go. I skipped a few again. Let's hope I didn't skip too many. Let's see. Charlene, how do you assist with estate planning or trust? So Charlene, when I do estate planning for people, I normally go and work out what they need in terms of the estate to make sure that all debts are covered, their inheritance go to their beneficiaries as needed, etc., etc. So in terms of the estate planning, that's the first thing. We go and determine what your need is at passing away. Then I assist people with setting up their wills, and if there is a need for a trust, I assist them by setting up a trust with the lawyers that I work with. The lawyer that I work with is maybe I should not say but one of the leading lawyers in South Africa when it comes to trusts. I've been working with him for the last 25 years, and there's nobody that's got knowledge on trust that he has. So we can set up a trust, we work it into the will, we make sure that everything works together. The planning, the will, the trust, everything. And that is basically how I assist. And yes, the will, there's not a cost to drafting the will, but there will be a cost to drafting the trust. And depending on your situation, we will make recommendations as to how the trust should be set up, if there's a need for a trust, how the will should be worded, etc., etc. So once again, it comes down to your personal circumstances, how and what should be done. But we, especially on the estate planning side, that's where I give you the figures in terms of what your need is and what you must do to address that need if the need is not in line at this stage with what your circumstances are. Michael, thanks sir, we really appreciate the time and effort you put. Oh, thanks Michael, I really enjoy this. I enjoy having these chats and I enjoy helping people. I'm battling to get a benefit statement 2024 of my pension fund. They keep on saying they are calculating it. Is that a red flag? I don't know if that's a red flag. It shouldn't take that long. I think it depends on which company you're with. But what I can tell you is, number one speaks to HR and asks them to help. If HR is not helping, they most probably just don't know who the heck to talk to. So find out who's the administrator of your pension fund, because if it is a company, a private company, it's normally investment house such as Alexander Forbes or Alec Gray or Old Mutual or Sanlam or whatever that's administrating the fund. And then you can contact them direct. Then you don't have to worry about HR. You can just go straight to the administrating company and you can ask them for it. So it shouldn't take that long. That I do know. Very possible. I have come across it a number of times where I've actually had to speak to people in HR on behalf of clients, purely because HR does not know what the heck is cooking in their own back room. But yeah, I don't think it's a red flag. I think it's just people that doesn't know what to do. Then let's see. Vimo, what are your top 5 stock picks for 2025? Yes, no, it's a game. I was just asking. Vim, I do not do stock picks, mate. Like I've said from before, I work with portfolios, and the portfolio manager that manages the portfolios that I invest my clients' money in, that portfolio, it's his responsibility to go and do stock picking. He's the one that has to go and decide whether he's selling Tesla this month and buying Microsoft, or selling Alibaba and buying Richmond. I don't get involved with that. If I wanted to be a stockbroker, then that is the only thing that I would have done. And yeah, there's too many horror stories of how these people stress. So I leave that in the hands of portfolio managers. And when people say, but yeah, they want to go and buy and sell shares themselves, then I say, great, go and open your own share account and read up on it and do your own picking. But no chance I'm gonna put my head on the block for that, mate. Quentin, dankie meneer. Agree on your comments. Recrypto, Bitcoin is like a stock now, correct? Which arbitrage company? Arbitrage company. It won't be right if I tell you, because then you're going to go straight to them and then I don't make any money, mate. I want to earn a commission. Hey, come on, don't be like that. I like using Future Forex. I believe they're very good. We've done our due diligence on them, and yeah, I make use of Future Forex. Quentin Jones, dankie meneer. Agree in your comments. Oh, which arbitrage? Oh, that was you, Quentin. Sorry. What percentage should us under 40s put in Bitcoin? Sam, it's impossible to say. It's like asking me how long is a piece of rope. It's like saying, okay, how much money should I put into shares? How much money should I put in the bank? How much money should I... Can't tell you. It depends on your personal risk and your risk profile. Some people will absolutely go nuts and put everything into Bitcoin or cryptocurrencies because they believe in it. Then there's other people that won't touch it with a 10-foot barge pole. So no, you can't. There is no set specific percentage for any type of asset class. It depends on you as the individual, what you can and cannot do in terms of risk, what you're willing to do or not to do. Okay. So that's my answer to you, Sam. Sorry, mate, can't give you more than that. What is your opinion on Access bonds as an investment strategy, be it short or long term? Access bonds is not an investment strategy. That is my view. Remember, an Access bond is where you've gone and you've borrowed money from the bank to buy a house. And if you've got a R1 million bond and you pay it off faster, all that you have done is you've paid the debt that you've made, and all that you have saved is the interest that you would have been paying the bank. Now, if you pay off that bond and you leave that access bond open, then you have access to those funds again if you need money into the future. But the moment that you go and take money out of that into the future, then you have to pay that interest again. So an access bond it's not an investment. That is the bottom line. It's not an investment, short-term or long-term. The only good thing about a bond is the one that you pay off quicker. Because the quicker you pay it off, whatever the interest rate is that you add on that bond, that's what you're saving. So let's say you've got an 11% bond interest rate. It means that you are saving yourself 11% interest that you would have had to pay because you're paying it off sooner. But it's definitely not an investment strategy. Absolutely not. Okay, hi Corey. Avi Grobler. Whoa, Avi, where did your comment go? There's your comment. Oh, hang on a second. There we go. Avi says, ek wil weet, wat is jou opinie op vir 'n groot maatskappy gewerk of die eie ding te doen? Avi's question is, do you go and work for a big company or do you start your own thing? So Avi, here's the thing, mate. Look at the stats. The stats says every 10 companies that are started, every 10 businesses started in South Africa to survive. So that's the risk. If you start your own thing, you've got a 20% chance of making it. Now, if you make it by starting your own business, you are most probably going to make more money than you would have earned with any company, no matter how big they are. So I think it comes down to you have to decide how much risk you're willing to take. If you want to be on the safe side, on the conservative side, and ensure that I'm earning an income, I'm earning a good income, and if I manage that good income well, I will have a prosperous and wealthy life. Then you go and do that. But if you're willing to take that chance that you can be one of those 2 out of 10 businesses that survive, and you're willing to take that risk that if it does not pan out, you might sit on street and gonna be broke beyond your wildest dreams, then you do that. So Avi, the one thing I can tell you is, mate, maybe you should go and work for the big company. Go and work for them, get the income, whatever. And while you are doing that, you go and educate yourself on business. You go and read books on business, how to manage a business, how to run a business, how to do the finances, how to do budgeting, how to do the marketing, how to do all of that stuff. And you make sure that you educate yourself well in how to run a business. And then you can decide, listen, I'm going to start the business on the sideline. And I'm going to build it up like that, or now that I understand business, now I'm going to resign and now I'm going to start my business. For the plain and simple reason is that too many people think they've got a bright idea with regards to business. It must work, cannot fail, whatever the case might be. And they jump into business, but they have absolutely no clue on how to run and manage a business. And that is the thing that kills them. Because it's easy to start a business, but it's not easy to make a business work. I hope that answers it for you, Avi. Let's see. Somebody sent me an ice cream cone. What am I going to do with the ice cream cone I can't eat? Quinn says, I'm with them already. When does tax season open? I don't know. I must be honest with you. I honestly don't know. And the reason I don't know when tax season opens is because I've got an accountant that does my books and my personal taxes. And that's his problem and his responsibility. So I honestly don't know. I'll have to contact Nico and ask Nico to sit in one night and answer some tax questions. Ek bedoel, soos moet ek my eie praktyk gaan stig vir finansiële advies of eerder net bly. So Avi, I don't know where you are currently, mate. I don't know if you are with one of the big companies like the Old Mutuals or the Sanlams or whatever, whether you are with a big brokerage, whatever the case might be. And once again, I think it goes 2 ways. I mean, I've got 2 businesses. I've got a brokerage and I've got an Old Mutual franchise. And the positive is for advisors that slots in to my businesses is I can offer them the same commission they would have gotten if they started their own business, but now they don't have to pay the compliance and pay the astute and pay the CRM system and the FNA systems. So they don't have those expenses. They do not have to worry about the compliance. They don't have to worry about complaints because all of that's taken care of by the company. Okay? So from a cost and a stress perspective, I would say it's better to stick with a company. But then at the same time, if you work for a company where they have a severe cut in commission to give you all of this stuff, well, then one might as well go and do your own thing and say, hey, listen, yeah, I'd rather pay for this stuff than see 30 or 40% or 50% of my commission going to them. So, Avi, I think if you really want to, we can have a bit of a discussion. You can contact me on my WhatsApp number, and then we can have a bit of a discussion, and maybe, just maybe, I can give you a better understanding of what you can expect by sticking with the company or starting your own thing. And that should give you a whole lot more clarity as to what you want to do. It also, once again, gets back to that old thing of different strokes for different folks. There's some reasons that you really feel that you want to start your own thing or really feel you don't want to. And once one can figure that out with a bit of an understanding, you'll be able to quickly and easily make a decision. Charlene says, how does one check if a financial advisor is legit? Charlene, you want to check up on me? So, Charlene, you can go onto the FSCA website and you can go and search a financial advisor there. And the financial advisor has to be registered with the FSCA. That person has to be on a license, a financial company license. And that is where you can go and check whether that financial advisor is legit. They also have a list there of all financial advisors that's been debarred, that's got complaints against them, etc., etc. So you go to the FSCA website, and that's where you can go and check it. Avi says, my accountant said it's in July, I'm not sure. It's possible, Avi. I really don't know. I know that people normally start asking me around about now for their tax certificates on their retirement annuities, specifically for their tax returns. But I also do know that it's normally here by about September that my accountant starts jumping up and down if I haven't sent him certain documentation. Wait. My accountant says, yeah, okay. Obviously, I'm with Old Mutual, and I took over my dad's practice, and I built my own client base as well. Well, Avi, fantastic. So, Avi, if you're with Old Mutual, there's a number of Old Mutual divisions. You can be directly with them with PFA. You can be with the franchise division, AFD. You can be via the BD or broker distribution division. So each of those have their own advantages and disadvantages, so to speak. So once again, Avi, give me a call, mate. Let's have a chat, and I'll give you my opinion. I don't want to, what do we call it, sit here and discuss financial advice roles tonight. But I mean, you know as well as I know that if you do leave a financial services company, strictly speaking, you can't take your book with you, you can't take your clients with you. So that is a big determining factor at the end of the day that has to be taken into consideration. So depending on where you are and what you can and cannot do in terms of moving, very important thing. So send me that WhatsApp, let's have a chat, coffee on Teams, whatever the case might be. And I will give you a very good idea of all the different divisions, wherever you are at the moment and the others, and what will happen if you do move from one to the other or move into your own space and start your own thing. Who's next? Yeah. That guy. My uncle invested 750k from his pension. Now they'll only release half. That guy, I have no idea what type of investment he invested in, because quite frankly, I don't know about any investment where they will only release half. If you're in a unit trust, you can withdraw all the money immediately. If you're in an endowment, you can withdraw all the money immediately. If you're in a retirement annuity, you can't touch the money until you get to the age of 55, and then you can take 1/3 and 2/3 as monthly income. If you're in a living annuity, you can choose an income that's percentage based, but you can't choose to take half of it. So I honestly can't tell you why you're saying that only. If I understand what product it is, I could maybe give you an answer, but based on what you're saying, yeah, can't give you an answer. Knowles, I'm in an RA for a few months now. How do I get a tax rebate? So Knowles, at the end of the financial year, the insurer will give you a tax certificate, tax directive. And when you do your personal tax returns, on your e-filing, whatever, you go and put in, this is my tax directive. I've been contributing, let's call it 1,000 Rand a month, so I've done 12,000 Rand. And then when you do that tax return, then SARS goes and they have a look and they say, okay, your income was 10,000 Rand, so it's 120,000 per year. The tax that you paid us, the PAYE that you paid us, is exactly right, exactly in line. But now you've got this tax or the retirement annuity contributions, and then SARS says, okay, because of these contributions, you've actually paid us more tax than what we needed because we never gave you the rebate. And then SARS says, okay, yeah, Knowles, here's the money back in your bank account. And that is how you get the tax rebate. It's on the tax return that you complete on a yearly basis. But this is where it's important to speak to somebody that understands tax so that they can explain it to you, because very often people contribute to a retirement annuity, but their taxes are already, the accountant, whoever handles the retirement annuity and the income, whatever, already takes that tax rebate into consideration. And they already deducted monthly from their taxes. So you are only supposed to get out 8,000 Rand a month, for argument's sake, from your salary. But now you actually get 8,500 Rand because your accountant has already worked that tax rebate into your gross income. So very often people don't see this rebate and they're like, I never got anything back. You've actually gotten back from SARS every month that 500 Rand, which you shouldn't have gotten back. So speak to a tax consultant so that they can explain to you how your taxes work with your retirement annuity. Okay. What's your opinion about level versus age-rated life insurance? Which do you offer? So France, as a matter of fact, there's a number of these. It's level, it's 5% compulsory, it's age-rated. Those are the three. And my opinion about it is, it's for different people, there's different reasons to take it. So let's put it this way, Frans. So let's say, for argument's sake, you are 60 years old. You've just bought a house for some other weird reason. The bank says that you must have life cover. You're going to pay off this house within 5 years. And part of the deal is they say you have to have life cover. Well, then it makes sense to take the age rated, because you're going to pay the lowest possible premium. It's going to increase by 6 or 7% yearly. And in 5 years' time, your bond is paid off. You don't need the life cover anymore. You can get rid of the policy. So from an affordability point of view, the age rated is then the best. But let's say you're 25 years old and you are taking out a life policy with the intention of taking it out for the rest of your life. You are working with a plan into the future. Then the level would be better, because although it's going to be more expensive than the 5% compulsory or the age rated, in time, the level is going to be the more affordable one over the longer period of time. So it depends. It depends on where you are in your life, what you need to cover for, what your affordability is like. I cannot tell you how many times I've had to do life policies for people with a 5% compulsory premium increase, purely because they needed a set amount of life cover. but they can't afford it. So they go with the 5% compulsory, which gives them the lower premium. And we're like, okay, you're just going to have to bite the bullet every year, because every year you're going to have to this 5% increase. And then at some point they go, it's 10 years later, man, this is starting to kill me. Well, 10 years ago you didn't have the money, so you didn't have a choice. So there is a place for each of these. I think in our industry, my biggest gripe with regards to it is that very often financial advisors want to do business, get business, and then what they do is they quote clients on age rated, and they show the client how much cheaper that premium is versus the policy that the client already has, and they use that by not explaining the different increase options in order to get the business. They get the business, they write the commission. 3-4 years later, that client comes to me and he speaks to me and he says, this thing is getting so expensive. Because I gave you an age rated, and what you had was a level premium, and that's why it was cheaper. But now 4-5 years later, hey, tough luck, it's too late. You can't go back and kick the oak now. So each of these have their place. Each of them have a reason why they're in the market. And the important thing is that when you get advice, that the advice is in line with the premium increase facility to give you the best value for your money. That guy, he wants to withdraw all of it. I understand that he wants to withdraw all of it, but I don't understand what product it is, my mate. If I don't know what product it is, I can't tell you why he can't withdraw everything, or why they say he can only withdraw 50%. Avi, thank you, I'll do that. 100%, Avi, I'm looking forward to speaking to you, mate. Great stuff. That guy, find out, let me know. My WhatsApp number is in my profile. You're welcome to send it to me and I'll help you. 100% Knowles, it's a pleasure. Obviously, hi, Corey, what's your opinion on using a tax-free as pension substitute for the 1/3 that you can get? What's your opinion on using a tax-free as pension substitute for the 1/3 that you can get? Obviously, I'm not 100% sure if I understand the question, but if I do, and let's say, if I understand you correctly, you're saying, okay, let the client not withdraw the 1/3 and use rather everything in order to, just a second here, got one of those funny things that I have to do at this time of evening. There we go. Don't take the 1/3, take the full amount, buy an income, and actually have your tax-free on the sideline and taking income from that as well. Don't know if I'm 100% with you. So to me, no. I don't mind people having a tax-free account and a retirement annuity. As a matter of fact, if you've got both, you've got the best of both worlds, because both of them are giving you that tax-free growth, and you can use both of them for income into the future. The 1/3 that you get from your retirement annuity or your pension fund, if that 1/3, if that thing is used correctly at retirement, that is where the magic comes in terms of creating the right income and getting the best tax benefits. And sometimes it's the best to take the 1/3 in cash, even though you're going to pay tax on it, and sometimes it's not. So, like I said, I'm not 100% sure that I understand the question, but when you pop me a WhatsApp, maybe you can just elaborate a bit, and then we can discuss this as well. I'm just not 100% on with what you're asking. Ladies and gentlemen, it is amazing, but for some other reason, I actually got through everybody tonight in 1 hour. It's 7 o'clock and I've answered all the questions, which is fantastic. So I want to thank you all. Thank you very much for joining me. It's been fun as always to have a chat to you guys, to answer some questions. Hopefully I've given you some value. I really hope so. If you need more answers, you're welcome to contact me. If I did not give you value, you're welcome to let me know. Thank you, everybody. Have a wonderful evening. All the best. Bye-bye.